Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. And what I have on the screen today, right now, is the weekly chart of the S&P 500. And last week, we didn't quite make it to the resistance area, and I'm not sure we're going to be able to. Actually, this is a pretty significant selling day, and usually the selling continues. Although it might not continue right away, but it's unlikely that we'll be able to retrace this day, or this week, immediately this week. So it's likely what's going to happen is we're going to bounce a little bit. We might go down a little lower and then bounce a little bit, and that bounce should kind of stop where I have this 2090 area, maybe a little higher, and then at least roll down to a support area below this low. So what we can do is we can create one of these boxes here just below this area right here, say right there, and we should expect the market to move to this area near term. So expect it to do this. Although it might kind of like this coming week, it might chop up a little bit. It might go a little higher and then roll over. So and it might take all week to do that. You might just get kind of an inside week. Something that looks like this with a tail that goes up and a tail that goes down. So something that kind of looks like that. That's certainly a possibility. Personally, I'm hoping that the market bounces a little bit and then rolls over. And that could be me just superimposing my my trading plan here, but I don't think so. This was a pretty significant week, and I'll show you in a minute on a shorter term chart on NinjaTrader. Where there was some pretty significant selling there. I think again, I go back to kind of what's driving the market. I think the key market to watch is this interest rate market. I think people are starting to feel like now that these interest rates are not going to stay down, regardless of what the Fed does, and that's probably spooking the market a little bit. Plus, we've been getting for about 6 months, we've been getting some fairly negative economic data. Most of it's been ignored, but it's been pretty negative. And once that starts to pile up like that, traders start to pay a little closer attention to it. There's not any one piece of data they look at, except maybe the jobs data pretty carefully. But there's just been a ton of trade deficit data, jobs data, GDP data. I mean, there's just a ton of it coming out, and it's not looking all that great. So traders are starting to react to that, and I think that's one of the reasons you're seeing this interest rate market move up the way it is. Of course, we're looking for movement above this red line here to confirm that the downtrend is over. But keep in mind, these are weekly bars. And you can see what happens when you get a break of a weekly bar. It tends to continue for some period of time. So if you look at this one right here, we had a break below this low, and then the market continued down pretty good ways. We had a break below this low, and the market continued down a pretty good ways. So, same thing works on the upside. We had a break of this high, and the market should continue, pretty good ways, which it has. And at some point here, we'll get a little pullback, and then we should get a continuation higher. Again, the thesis, just to reiterate, I know I keep pounding this, but it's super important, especially if you have bond funds. We're currently operating under the assumption that this is the low right here. This July 23rd, the week of July 23rd low. And this was the first move off the low, and this was the first correction. If that's the case, then this next move should be pretty significant. And I'll show you an example of that in NinjaTrader in a minute on a shorter term basis. And the stuff that happens in short term on a short term basis also happens on a long term basis. Oops. And we could show, at some point we could show, well, I don't know why that keeps coming up. I guess I need to buy some Norton antivirus. Anyway, we could show, and I've talked about this before, but the patterns that show up on the long term also show up on the short term. It's generally, I say generally means kind of widespread. I wouldn't say this is a widespread opinion, but some people believe the market is a fractal. That, in other words, the smaller term patterns, like a snowflake, the smaller patterns gather together to make a bigger pattern that's just a larger version of the smaller pattern. So we can get into that more or less. I mean, I don't know. There's not a whole lot to say other than that. Let's look at the volatility index. We've been watching this green line, and I've left it on here because, it was appearing to be pretty significant, and I think it still is. But you can see that we've stopped going down, at least for the time being. Although this hasn't, if you notice, this hasn't taken out. Now the VIX doesn't trade the same way as the normal market, so. But you can see that we haven't closed above this high, so we could get something that looks like a doji. A doji is just a very small body candle with some longer, tails on it. We could get a doji, and then the following week, maybe get something that looks like this. So that's why I think the market, it's likely to bounce a little bit here, maybe 20, 25 points, and then kind of resume. And this bounce would be, if it bounces, this would be the VIX, coming down to this area here. So when the market bounces, this would run down here, and then once it's through bouncing, then continue the sell-off, which would drive the VIX this direction. So the VIX, we've talked about it before, but the VIX moves opposite of the, sorry, I can't get my thing going here. It moves opposite the direction of the market. So if the market's down, the VIX is usually up. And if the market's up, the VIX is usually down. And really what we're looking at the VIX for is just confirmation of the direction of the market that we've observed. Let's look at the Euro-US dollar. Euro-US dollar, there was another announcement last week. What's interesting about the euro is they keep talking about QE over there, and yet it's not as easy for the central bank to do that because there's multiple countries involved, and not all these countries agree on that path. So you've got kind of a political thing mixed up here in the economic thing, and it's just brutal, though, man. I mean, the euro is just, the people of Europe are losing wealth at a rapid pace. I mean, they're going to start buying. Basically, what's happening here is everything that they buy is more expensive relative to dollars. So oil, whatever goods they import into Europe from the United States are becoming more and more expensive. Now, if they're buying European-made goods that are made in Europe, in the Eurozone, they're not spending any more money. But countries, trade with one another, and when you see big moves like this in the forex, in the foreign exchange markets, it causes serious disruptions to consumer spending and critical things like that to the economy. So we haven't seen the fallout of this euro falling this much. I mean, this is just a huge move for a large economy like Europe. I mean, we're talking about That is a 23% move in how many days, much time? In just under a year, 308 days. So that's not an insignificant kind of event in Europe. And I suspect this is going to have serious repercussions around the world. Let's look at Germany. Now, so why is Germany up? Here's the trend for Germany. Well, when your currency loses value, everything that's denominated in that currency goes up. So it's the same reason the stock market goes up here when the dollar goes down. Essentially, there are companies in the exchange. Let me just talk about the U.S. market, since that's easier to relate, and then you can think of it just the same way for the European markets. But let's say the dollar goes down. Well, there are companies in our exchanges, in our Dow 30, S&P 500 that are multinational companies. So when the dollar goes down in value, what that allows them to do is to export to the rest of the world more cheaply. Now, and there's essentially no change on their domestic business. So effectively what they get is, it's like they're running a big sale on all the items that they sell overseas. But everything that the U.S. would import would become relatively more expensive. So anything coming from China, anything coming from Germany, anything coming from the UK, these goods from these countries would all be more expensive on a weak dollar. And so you basically have the same thing going on in Europe. And Siemens and companies like that sell overseas, their markets are, they basically, all their goods are on sale. They're selling their goods. Let's say they're selling them for the same price, but the demand for their goods is greater because they appear cheaper in the U.S. So that's kind of how that works. Let's look at, I guess we can look at the UK real quick. The UK, we've been following the UK, and we said we've got our decision point resistance area up here on the UK, and it didn't quite touch it. Now these are, you've seen me draw these. These are just very arbitrary, but they're based on, for those that haven't seen me draw them, they're based on some previous high. So what I did is I estimated this box off of this previous high, because what happens is the market tends to swing from pivot to pivot, and when it goes to the next pivot, it swings just past the previous pivot. So you can see this pivot here, and it pivoted to here. So pivot from here to here, and then it pivoted here, and you can see that this is just past this pivot. And this is the way the market travels. So that's why this box is drawn where it is. We had talked about the UK. I'll tell you what. Let me not do that. We talked about, since it had broken out of this channel right here, broke out of the channel right here on this. Let me take this Fibonacci. Well, let me leave the Fibonacci on there because we're going to refer to it in just a second. So we broke out of the channel right about here and pulled down, and we talked about having a bounce, and that bounce was somewhere between 50% and 62% of the previous move. And so that's where the box is drawn. It's actually drawn right over the 62%. And we got a little less than 62%. We got, about a little more than 50, a little less than 62. So I don't know, 55, 58% retracement. And then what you're going to see the UK do is come and make a lower low, lower than these, somewhere down in here in the 16 area. So once a market breaks a support area, that support area tends to be resistance. And that's what you're seeing with this diagonal line here. This diagonal line now is resistance to this trend, or excuse me, to this upward trend here. And and then the market should roll down here into the 16 handle area and make a new low. And you can see the MACD, or the stochastic here, is just now rolling over. So this is probably going to go maybe even lower, maybe down here into the 15 or 13 area. So it should be a pretty significant sell-off. So if you're invested in the FTSE, if you're indexed in the FTSE, you might want to take some off or hedge or step to the sidelines, depending on what your trading, your investment tolerance for risk is. We just incidentally, we're pretty long in the tooth in this bull market. I mean, you can see here we started back in 2009, and we're now in 2015. It wouldn't be the dumbest thing in the world to take a little off and step to the sidelines, because if we go back even further, well, let's not go back on. Let's go to the S&P 500 and look at 20 years worth of data. You can see the market. I mean, I could measure these. Let's measure this one right here. From low to high is 1,826 days. So that's about, almost 6 years. This here has been, how long has this been? Well, got to measure it. This most recent run has been almost 2,200 days, so quite a bit longer than this run right here. And if you go back and measure this one's, I think, longer than this one. So we're just, it's not an imprudent, thing to do, to take a little money off the table and just, and just say, enough. Now, what you could do is you could wait and see if this low gets taken out. If this low gets taken out, let's just talk about that, because that's probably a better strategy for a 401k. Let's say the market moves down to here, okay, and then we get a bounce, but the bounce only comes to maybe here, okay, and then rolls over. I think you could probably say anywhere along in here, okay, that's it. I'm stepping to the sidelines, because now we've got a lower low, right, and a lower high, and that is a downtrend. So anywhere, maybe say in here, you could decide, okay, that's it, I'm out. And maybe it's too early right now. Maybe you wait until it come down, and then we get a bounce, and then if we do make a lower high, which this would be, and we make a lower low, you could maybe step to the sidelines somewhere inside this, between this red dash line and this red dash line, maybe something like that. So that's probably a prudent thing to do in your 401k. All right, what else can we talk about? Let's go look at gold. Let's go to the NinjaTrader and look at gold. Gold, we talked about, it broke this trend line, and we were looking for a bounce here. We still haven't gotten a bounce. Gold, I mean, it's possible gold can make a new low below this low here. If it does, it's probably going to make, it's probably going to go below 1,100. I don't know if you recall or not, but we talked about, when I was first talking about gold, we really talked about it going down below 1,000, and I was kind of shocked that it didn't. So if this break of trend line up to the upside doesn't hold up, I'm not entirely surprised, because to me it didn't look like gold went quite low enough. So if you're looking to buy some gold, maybe you hold off a little bit and see if you can get a better price. Although to me, this is if I were looking to get into gold, I probably would have tried to get in somewhere here. But again, if you really analyze, if you look at this, we never closed above a previous high. So this high right here, the following week we didn't close above it. This high right here, this week we came close. Well, actually we didn't come close because the close was down here. But it looked like, I mean, if this had been a blue candle and it closed, let's say right here, this would have been your entry for gold. Okay. But if you notice, it never has. And so let's say next week it looks like that, and then next week it looks like that, and then next. See, it never really gives you a break above the highest day. So you would need a close above that day right there. Well, if you got another bar that looked like that, well, clearly you didn't close above that. You got another bar that looked like that. So what we're looking for is we're looking for a situation like this situation right here. So, you know, here's your, it stops going down, it goes sideways, and then you right here on this candle right here, you get a close above the high day, or excuse me, the low day. But in this case, it didn't break the trend line, so we weren't looking to get into gold right there. So anyway, that's a little bit of, you know, Monday quarterbacking there. None of that does you any good. You have to kind of make a decision and go with it. Let's look at crude oil. We're looking for crude oil to bounce into this area here. You can see that we had a significant sell-off since June, and we're looking for crude oil to bounce up into this area, this $70 area, and it has yet to do that. Now, the one thing I wanted to show you, I'm going to show you the weekly chart on the S&P 500 real quick. And then, let me scoot it over here a little bit. So you can see, I don't know, right here at the end of the year we got a DP signal, which would have taken the target down into this area, this 1700 area. And that's when we were looking at the break of that rising wedge. And remember, we broke out of the rising wedge, then the market found support and rallied back up. So that rising wedge didn't work out. Well, we're getting a very similar signal here. We got a DP last week on the S&P 500. And, you know, ultimately, if this trade works out, this signal will take us down to the 1955-75 area at a minimum. So I think there's probably, you know, real need for caution here. If you're a shorter term trader, you might look to try to get out of a long position on a bounce next week. I think we could bounce 25-30 points next week before we resume this downtrend. And I'll show you why I think that. Let me go to a shorter term. Remember, we talked about the market being a fractal. So this is a weekly chart. So each one of these is a week. Each bar here is a week. And generally what you do is you go to a daily. In fact, let me just do that. Let's look at a daily real quick. And the daily is not really showing me anything, although I do see a small pattern here. But if I go to the I have a 120-minute chart here also. You can see here that the program is found a 1, 2, 3. And of course, what comes after 3 is 4. Now it could go a little lower. You know, we got kind of a support area off of this low here around 2050. So we could go 20 points lower first, but it's perfectly reasonable to see the market bounce here up into the 2090 area, and then roll over and maybe come down into this 2032 area. So if you're long, you could you know, wait for it to stop going down, wait for a bounce, and then get out on a bounce before it rolls back over. But ultimately, this first move down, which is what I'm seeing here is the first move down, is going to come down to this area here. It's going to come to at least the 2025 area. So I'm looking to get out on a bounce, and then and then either go short to this area or just sit on the sidelines and wait for this first move. That's kind of the way I'm approaching it. And you can see we've got rising volume here on the 120-minute chart. I'm assuming you can see that. It might be out of the field of view. Let me zoom in here and pull it up. So you can see here we got rising volume. And and then also we're kind of carving out. A lot of times this indicator here will kind of be one of these and then start to go back up. So we've got maybe another down bar here, and then these bars are going to start getting shorter. They're going to maybe get one like that, and then they start getting shorter, and the market starts to roll back up, maybe like this. Okay? So we'll look for that to happen. Again, these are 120-minute bars, so this is only, this is certainly the week. I would say you're gonna have a little bit of down, a little bit more back up, and then before the week's over, we'll probably see down again, like this maybe. So we'll be able to come back and look at this, but I've observed this many times, so it's now where might this go? Well, let's see if we had up wave 4. We've already talked about it, but I can get this software to cooperate with me. No, it's not drawing it in here, but it would take you to somewhere around this area here, somewhere around there, around 2090, 2095, something like that. All right, is there anything else? I guess we can look at the DAX real quick. So you can see the DAX looks really strong. And I go back to this is, pretty much due to the euro, in my opinion. So you can see we bottomed out on the DAX around October 17th. And the euro really started getting ahead of steam. Let's look at that. Let's see what this date is. This is May. So right around, well, what's interesting is, let's look at this real quick. What's interesting is the euro. You see this support area here? We had drawn this support area, and it looked like it was going to hold. And then when it broke that support area, so this is this week right here is the week of October 26th. This week right here is the week of October 19th. So once it broke this area, look at the DAX. Look what the DAX did. Here's the DAX the week of October 17th. So as soon as it broke that shelf, the DAX took off. And again, you would expect this because the German people, they're shipping their goods all over the world, and they're shipping them based on the price of the euro. And all of a sudden, things that you buy from Germany look cheaper to the rest of the world. The market says, well, supply and demand. If prices go down for goods and services, the demand is likely to go up. So the expectation in the market is, hey, the DAX is going to do better. Companies are going to make more money denominated in euro. So German companies are going to make more money denominated in euro. Now, this is bad. This is bad for the German people because basically their money, the euro, it buys less. Now, it buys the same amount from everybody in the euro. But if they're buying goods from China or they're buying goods from India or the U.S. or anywhere outside of the eurozone, they're paying more. So, and this is just the world of relative value with respect to currency. These currencies aren't backed by anything. These central banks come in, they make a decision, and basically what you have in the financial markets is people adjusting to those decisions. And so this is where things get tricky when you talk about the economy versus the market. Just because the DAX is going up doesn't mean there's prosperity in Germany. There might be prosperity for some people, but for other people, there's no prosperity. And it's the same way in the U.S. I mean, just because the markets are going up, I mean, it makes sense. It should make sense to most of you out there. Just because the markets are going up doesn't mean prosperity for all. It means prosperity for some, but not for all. And, this is why I think the currency manipulation, the currency war works on the surface. It doesn't work in the sense that it creates a healthy economy, but it does create an environment where some people, and usually the political class or the connected class, is winning. So that's why politicians like to do it. All right, I guess that's about it this week, everybody. I didn't have any comments from anybody about what they'd like to see, so I'm just going to continue to. We'll end on the picture of the S&P 500. I'm just going to continue to proceed in this way unless I hear from somebody. But you can go to the YouTube channel. I don't have it up to show, but it's if you just go to YouTube and search on Middle Class Investor, you'll find the YouTube channel. You can also, a lot of times I'll post these videos on Twitter at the @InvestorClass. So you can follow me there at InvestorClass. Okay? Thanks a lot, everybody. We'll see you next week. Take care.